case 2 was when provision for depreciation is created. Now students, in this case, since the provision has been created, that means depreciation is charged as per straight line or written down value method, but it is not deducted from the value of the assets. Depreciation is transferred to provision for depreciation account. Depreciation is charged on cost or book value, but not deducted from assets. From assets, rather it is transferred or accumulated in provision for depreciation account. So in this case, the assets will continue to appear on its cost, whereas the depreciation would be accumulated in provision for depreciation account. Let us understand what are the journal entries in this case. Journal entries. Now students, when the assets are purchased, in case the assets are purchased, entry is assets account debited to cash to vendor, that is the seller. Assets are coming in, real account, debit what comes in, cash is going out, credit what goes out. Then when depreciation is charged, in that case it would be depreciation account debited to provision for depreciation. To provision for depreciation. Now students, it is very clear from here that it is not being charged directly to assets. It has been transferred to provision for depreciation account. And at the end of the year, depreciation is an expense. Since it is an expense, it will be transferred to profit and loss account. That is profit and loss account debited to depreciation account. Remember, in this case, the asset will continue to appear at its book value, whereas all the depreciation that we have charged for n number of years would be accumulated in provision for depreciation account.